Welcome to the Q3 update of the Office Investment Review. Q3 was a very active quarter for the office sector. Over the first 9 months of 2014, transaction volumes were almost 13 billion, almost the same figure as the record year of 2013. With a number of large transactions expected to complete over the remainder of the year, 2014 will be a record year for transaction volumes in the Australian office sector. Over the quarter, a number of benchmark transactions occurred in Sydney, Melbourne and Adelaide. As a result, we recorded yield compression for both the Melbourne and Adelaide CBDs. At the tighter end of the range, prime equivalent yields have moved below 6% in the Melbourne CBD. We're now recording the tightest level since 2007. A number of domestic investors, A-REITs, wholesale funds and superannuation funds hold an underweight position to the Melbourne CBD office market. We estimate that Melbourne accounts for 22% of capital stock by value across the 6 CBDs. Therefore, an investor following a strictly value-weighted asset allocation strategy should have a 22% allocation to Melbourne. Historically, Melbourne has been a low-risk investment destination. The volatility of returns for Melbourne over the past 20 years has been lower than Sydney, Brisbane and Perth. As a result, we expect to see a number of domestic investors look to increase their allocation to the Melbourne office market in 2015. A shortage of core product across the main CBD office markets has resulted in a number of investors reassessing the investment proposition of the Adelaide CBD. We currently see that the yield spread between Adelaide and the other CBD markets is wider than historical benchmarks. Furthermore, Adelaide has a relatively diverse occupier base and tends to record very few years of negative absorption through the cycle. One of the limitations of Adelaide as an investment destination is a shortage of prime grade assets. However, for an investor with a mandate for A-grade product between 50 and 125 million, Adelaide is actually the second most relevant office market behind the Melbourne CBD. The outlook for the investment markets is strong in 2015. However, a shortage of fund-through opportunities and fewer large assets being offered to the market will result in lower transaction volumes in 2015 than 2014. As a result, we expect to see a number of investors reviewing the opportunities for good quality B-grade product and a greater focus on the decentralised markets in 2015. Thank you for your attention today, and if there's any questions that you have on the office investment markets, please contact me or any of my colleagues.